Hello and welcome to our new video that I was really looking forward to because it will be something slightly different than you are used to in our research. It will be about a very long-term ultimate value opportunity that is emerging in the markets right now. Before I start, however, keep in mind that everything I will tell you and show you today is intended only for educational purposes. We don't provide financial advice, and even if I'm gonna speak about specific financial instruments like stocks, futures, options, or ETFs, it's always for educational purposes. As you are probably aware, the stocks, commodities, and also some foreign currencies are selling off this week. This is obvious when I take a look at the price of S&P 500. This is the end of day price, and I'm doing this video on Thursday, so you'll probably see up-to-date chart when you watch this video. In any case, this is a typical sell-off, and I think it, at least for now, it doesn't look like as a start of anything meaningful because wrong chart, because when I open the risk assets, the chart I made a few months ago, you will see that two of the most important indicators of the risk attitude from the investors are still doing rather fine. So here on the top subchart is once again the price of S&P 500 futures, while in the bottom, in the middle subchart is the ratio between Nasdaq and S&P 500, while on the bottom subchart is the copper-gold ratio, important cyclical ratio, which measures the condition of the emerging markets, especially China. And the sell-off is quite steep, but there's been a little reaction from the Nasdaq S&P 500 ratio. You can see that it's still following this rising trend line, and the same can be said about the copper-gold ratio, which is also going higher. It has recently broken through this important resistance, and it is currently retesting this breakout. In any case, both copper and Nasdaq are relatively much stronger than the sentiment or the panic we're currently witnessing would suggest. Of course, there are two possible explanations, as there usually are. The first one is that the current sell-off, which still may be far from finished, is not as strong as it appears based on the sentiment and the panic and so on. The second explanation is that this is just the beginning, that we haven't seen the real panic yet, and these two ratios would eventually break down. In that case, stocks would go much lower, I think below 3,000, somewhere into the area around 2,800. So that's the second scenario. Both of these scenarios are possible, but right now our base case scenario, the one that is more likely, is the first one, which means that the sell-off may continue, but it is unlikely for the price to drop below 3,000, and it is basically a buying opportunity. So that's it. And now let's talk about the opportunity, the value opportunity I mentioned at the beginning. I have prepared a few charts, important ratios from stock charts. And the first chart is the value versus growth ratio, or the ratio between the price of an ETF made of value stocks and the ETF made of the growth stocks. The value growth definition is not entirely clear, but simply say that the value stocks are the companies that are trading, that are basically cheap, that are trading below their fair values. These companies are usually naturally priced lower than the rest of the market, and the basis of buying these companies or investing in these companies is based on the current state of affairs, which means that we or somebody is buying these stocks because he knows they are cheap, they are cheaper than they through value, and he expects this value will be recognized by the market in the future. Growth stocks, on the other hand, are usually not cheap, and if you take a typical company, which can be considered a growth stock, its earnings or cash flow is usually rising, the company is doing great, and the stock price is usually slightly expensive. But the thesis of the investment thesis of these growth stocks is that you expect that the earnings or the cash flow generation will rise even more rapidly than the market currently anticipates. So let's get back to the chart. As I told you, it's a ratio between the price of value stocks compared to growth stocks. The red and green curve is the ratio for developed markets outside of the US, and the black curve shows the ratio for the United States stock market. And this is a very long-term chart since the beginning of this century. And one thing is clear. The value stocks were never as cheap compared to growth stocks as they are now, if we start at the beginning of this century. While it is true that cheap stuff can become even cheaper, in my opinion, there are several catalysts why this ratio will probably turn higher in the near term. And by near term, I mean next year or maybe two, not next week or next month. You have to remember this is a very long-term phenomenon we are talking about right now. So let's start with more targeted ratios of few interesting parts of the stock market, of the most prominent value plays. What comes to your mind is obviously the energy sector. It's a typical value play. It's very cheap. It's dirt cheap right now. The first curve is the ratio between the ETF for the US energy sector compared to the broad SPY ETF. The second ratio is between the black curve is between the exploration and oil exploration and production ETF compared to the SPY, and you can see that the red and green curve is the ratio is already below the low in March, while the black curve is roughly at the testing the lows from March and the beginning of April. We all know the energy is dirt cheap. However, there are two specific niches in the market that I think will outperform in the long term, and I will tell you something about them at the end. The second play is the financials. The first curve, the red and green curve, is the ratio between the US financial stocks and the broad market. The black curve is the same for Europe. Both of these curves are moving down. The trend is still down in the same way as we saw on the previous chart. In my opinion, analyzing financials is a bit difficult in the current environment because their performance is mostly affected by the monetary policy. The negative rates and very low rates we are currently witnessing around the world are very negative for financial stocks, especially the banks. And it is not clear when the low rates around the world will turn higher. Generally, I think it's quite unlikely given the huge amount of debt around the world. So that's the reason why this specific part of the stock market will be quite risky. Investments, in my opinion, the financial stocks will be very risky. That doesn't mean it cannot play out. Of course, it can. But the risk is quite high. In my opinion, it's higher than in the energy sector. And the third part are industrials. The red and green curve once again is for the US ratio between industrials and the broad market. The black curve is for the European stock market, but I was unable to find out what stocks are included in the European index. Therefore, I don't trust this black curve as much. However, you can see that the industrials have probably already bottomed in April or May. And this is definitely a good part of the market because the risk here is, in my opinion, lower than in financials or the energy sector. On the other hand, the potential reward is also lower in the long term. Therefore, this is a more conservative play. There is also another part of the stock market that would benefit from the turnaround in value to growth ratio. And it's the small cap index or the sector of small companies. Here we have the ratio on the bottom subchart. We have the ratio between the Russell 2000 index, which is made of the small companies in the US compared to the broad S&P 500 index. And as you can see, the ratio has bottomed in March, but the recovery is very slow. Over the last 5 years, the ratio is considerably lower, which would be even more obvious when I show you the more longer-term history. On the contrary, it's been the technology sector that's been outperforming over the last few years. And I think there is a good chance this trend will reverse. As I said, it doesn't mean it will happen overnight or next week or next month, but over the next year or two, I think the financial stocks will come under pressure from the politicians because of the increased regulation. And these stocks, these large technology stocks, are already very expensive. So that's the reason why small caps will probably outperform technology sector over the next 5 or 10 years. But there is one part of the market that I want to focus right now, and it's the energy sector. We all know that energy stocks are very cheap right now. The fall in value was probably caused by the falling price of crude oil and the energy sources in general. Here is the price of crude oil, the Brent on the top subchart and WTI on the bottom subchart. And you can see that over the last maybe 10 years, the price is trending down. I think we're close to a turnaround, and by close I mean close in time, not price, which means that price can fall even much lower than we are witnessing right now. But in terms of time, I think the trend will change probably next year. Once the situation with the pandemic will get resolved next year, and I think it will thanks to the vaccine, demand for crude oil will be higher, and the supply will be, or the growth in supply won't be as large because of the underinvestments over the last few years in this sector. So the obvious way how to play this opportunity is to buy energy stocks. However, there are two industries, two subsectors that will benefit more than the rest. Let's talk about the first one. As you know, the US election is approaching, and there is a huge debate, not just in the US, but in the global investment community, about the future of fracking in the US. If Donald Trump wins, everybody expects the fracking will be stronger in the US, while if Joe Biden wins, there are fears that he may limit fracking in the US, which is true especially for the federal land. And while Joe Biden never said he will ban fracking, his administration would probably be less friendly towards crude oil and fossil fuels in general. So this poses a binary risk, which is quickly approaching. However, there is a way how to turn this into your advantage. I think that Canadian oil industry, especially the oil sands, will benefit no matter who wins. Why? Well, let's say that Joe Biden truly wins. In that case, it will be harder for the drillers, oil drillers in the US, especially the shale players. However, it will not affect the Canadian oil companies. On the contrary, the effect of Joe Biden winning the presidency would probably cause oil prices to be slightly higher than they would be compared to the Trump administration. And that's a great environment for everybody who's mining or drilling for oil. So this scenario would be great for Canadian oil companies because the prices, especially in the US, will be higher because of the restrictions or generally less friendly attitude in the continental US, while the Canadian oil companies won't be affected by this at all. Of course, there are similar tendencies and governmental policies in Canada too. But I think they are already priced by the market because they have a liberal administration, and I think the situation cannot get much worse for the Canadian oil companies than it currently is. So that's the reason why I think these companies, Canadian companies, will benefit under the Biden presidency. And now let's talk about what happens in the second scenario when Donald Trump is re-elected. I think that would be even better for the Canadian oil industry because, well, the prices might be slightly lower because of the good environment for oil companies in the US, especially the drillers. But if the production in the US, in the continental US, is strong, there will be also increased demand for the crude oil from Canada, Why? Well, that's because most of the crude oil produced in the US is very light and sweet, which is of higher quality than the crude oil in Canada, which on the other hand is very sour and heavy. The point is that production cycle of US refineries is optimized for a certain blend mix, which means that these refineries need the heavy Canadian crude oil or other heavy crude oil for the matter to optimize their production to produce all the necessary fractions from gasoline, diesel, and to the all the way to the heavier fractions, and they cannot change this. It's very expensive and takes a lot of time to retool the refinery to produce a different range of products and to use a different blending mix. So the refineries in the US, especially around the Gulf Coast, are optimized for using a lot of heavy crude in addition to the light crude from the US, because historically the production in the US was going down, and there was, or majority of oil was coming overseas from the Middle East or from Venezuela. And the crude oil from the Middle East and Venezuela is heavier than the crude in the US. Currently, however, the situation is exactly the opposite, because there is a lot of light, sweet crude oil in the US from the fracking plays. But there is a lack of heavy crude because the output from Venezuela is simply cut off due to sanctions, and the Saudi or the Middle East crude oil in general is mostly flowing into Asia these days. The only remaining source or sources of heavy crude oil in North America are Canada and Mexico. But the thing is that Mexico will be reducing the exports to the US next year because of additional domestic refinery capacities going online. So the only relevant source of heavy crude for US refiners will be Canada. And if Trump wins, there will be probably a renewed push to build the Keystone XL pipeline, which would help to bring Canadian crude oil into the or to the US market. And the increased production of crude oil, of light crude oil in the US, would mean that US refineries will be demanding a lot of heavier crude from Canada for their operations. So no matter who wins next week, Canadian oil companies will be doing fine over the long term. And now let's talk about the second great opportunity, which is natural gas. I have prepared a chart with the ratio between crude oil and natural gas. And as you will see, over the past decade, crude oil was relatively more expensive than natural gas. The ratio was much higher compared to the historical average, which, as you can see, is this cluster of bars. And the reason for this is that the shale revolution of the US unlocked a lot of crude oil, but also a lot of natural gas. And the fact is that natural gas production became independent of the supply and demand for the natural gas itself, because a lot of the natural gas was produced as a byproduct of the crude oil operations. So that caused a huge oversupply, which is finally coming to an end, as we can see not just from the ratio, but also from the higher prices of natural gas over the past few weeks and months. I made a comprehensive video about the long-term outlook for natural gas. I think it was this video from March. I truly recommend you to watch it because we were basically anticipating a change in the market, and we saw that the overperformance of crude oil relative to the natural gas will end, and the trend will reverse in the coming years. Moreover, a possible change in the U.S. administration, Joe Biden winning the elections, the U.S. elections, won't change this fact at all, because this trend is fueled by increasing demand for electricity in the international market, especially the emerging markets. And this won't change no matter who wins the White House. Moreover, I would even say that Joe Biden administration would be great for natural gas, which may sound surprising given his, not friendly attitude towards fossil fuels. But any support towards renewables equates support for natural gas. Let's take a look at California. They are building nat gas electricity power plants, rapidly because of the increased baseload generation. Renewables cannot solve the baseload generation. You need something else for that, and you need coal or nuclear or the natural gas, and the natural gas is currently the cheapest option. It's not the cleanest option. The nuclear is the cleanest option, but the natural gas is the cheapest, and it's the easiest to build. So the future for the natural gas is bright, and therefore I think investment in this industry will provide great returns over the next several years. Just don't forget, I'm talking about the long-term trends. It has nothing to do what the industry or the price of crude oil or natural gas will do in the next few weeks or months. This is truly a long-term opportunity, and it can take some time to play out. On the other hand, I think the current opportunity, and not just in the energy sector, but also in the other parts of the stock market, is much better than it is during the spring sell-off. That's the reason why we were cautious back then, because we knew that a better opportunity is coming, and we think it is coming right now. And that's because we have much more information now. There is much less uncertainties in the market. For example, we know what is the impact of fiscal stimulus on the market, and even on the micro level. For example, I was following the energy sector and even some companies well before the current crisis and also during the crisis. And some of the companies that I was considering to be great and was very optimistic about them turned out to be the worst because of their policies during the crisis and after the crisis. It was a huge surprise to me. So we have much more information about individual companies right now. We know which companies did great, which companies implemented the policies or the actions that will increase their cash flow in the future, and which companies will probably won't do great. So that's the reason why I think the current information advantage is great, and it will be a great opportunity. Maybe not tomorrow, maybe not next week or next month, but next year or at some point in the near future, these opportunities, these value opportunities will be really great.